Hello, and welcome back to my channel. It's me, and in the next 5 minutes, I'll share with you 5 themes I think will generate great returns in 2025. So let's start with theme number 1, and that is high growth. Tech is still the engine of growth, and even though it pulled back this year, experts believe that information technology and communication services will outperform over the next 2 years. They point to strong pricing power, innovative business models, and a competitive advantage in talent and capital. And within tech, artificial intelligence, cloud computing, and semiconductors are leading the way. So how do you gain exposure to these trends? Consider investing in tech-focused exchange-traded funds or ETFs like XLK, which tracks the Technology Select Sector Index. It offers broad exposure to large and mid-cap U.S. tech companies. Or you might prefer global funds like T. Rowe Price's Global Technology Fund, which targets fast-growing companies in the AI and cloud space. To mitigate risk, stick with large-cap tech leaders with solid fundamentals. This approach helps you capture the upside of this dynamic industry while managing potential risks associated with smaller players. 2. Defensive sectors. Financials, defense and utilities are poised to shine in 2025. When uncertainty looms, investors flock to defensive sectors that offer stability and consistent performance. These 3 sectors provide essential products and services that are less susceptible to economic fluctuations. Financials play a crucial role in facilitating transactions and managing risk, making them a key part of any economy. The defense sector enjoys steady government spending, particularly during geopolitical tensions. While utilities supply indispensable energy and water services, these sectors typically offer strong cash flow and the ability to raise prices when economic conditions worsen, contributing to their resilience during downturns. To tap into these trends, consider investing in sector-specific ETFs like Financial Select Sector Spider Fund, XLF. It provides broad exposure to the U.S. financial services market. Alternatively, for utilities, the Utilities Select Sector Spider Fund, XLU, which tracks the performance of the S&P Utilities Index, offering a diversified portfolio of utility companies. Additionally, dividend-focused funds like the SPDR S&P Dividend ETF, SDY, can be attractive as they seek to provide both capital appreciation and a steady stream of income. When selecting funds or individual stocks within these sectors, look for companies with solid track records, strong balance sheets, and a history of weathering economic storms. 3. The biotech boom. The global biotech market is poised for explosive growth, driven by factors like an aging population, increasing healthcare needs, and technological advancements. By 2034, the market could reach a staggering $5 trillion. This dynamic industry encompasses gene editing, the development of new treatments, and cutting-edge medical technologies. To ride this wave, consider investing in biotech ETFs like the iShares NASDAQ Biotechnology Index Fund, IBB, or the XBI, which focuses on small-cap biotech companies. However, it's important to recognize that biotech is a high-risk, high-reward sector. Clinical trial failures, regulatory hurdles, and patent disputes can significantly impact individual stocks. Therefore, diversification is crucial. Don't put all your eggs in one basket. 4. Emerging markets. Emerging markets continue to beckon with promise. As global economies shift and developing nations gain momentum, these markets offer exciting opportunities. Broad-based ETFs like the Vanguard FTSE Emerging Markets ETF, VWO, or the iShares Core MSCI Emerging Markets ETF, EEM, provide diversified exposure to a range of emerging economies. Within emerging markets, consider focusing on countries with strong growth potential, sound economic policies, and a history of attracting foreign investment. Additionally, explore funds or ETFs that specialize in specific regions or sectors showing promise. For instance, the Global X MSCI Nigeria ETF, NGE, offers exposure to Nigeria's burgeoning tech sector. Remember that emerging markets often come with higher risks. Political instability, currency fluctuations, and economic uncertainty can impact returns. 5. Green energy and crypto. The green energy sector is witnessing massive investment globally. A recent report by Bloomberg NEF projects that by 2025, spending on renewable energy will likely double that of fossil fuels. This monumental shift offers fantastic opportunities for investors. Consider funds like the Invesco Solar ETF, ICLN, or the Global X US Clean Energy ETF, CTech. These provide exposure to a range of companies involved in solar power, wind energy, and other clean energy solutions. Additionally, cryptocurrencies continue to evolve. Bitcoin ETFs now hold billions in assets, and the regulatory landscape is gradually becoming more clear. If you want a piece of this action, a small allocation to Bitcoin might balance your portfolio. But remember, crypto remains volatile and risky. Quick recap. We covered high-growth tech, defensive sectors, biotech, emerging markets, and green energy and crypto. Remember to always diversify, rebalance regularly, and know your risk tolerance. Don't invest money you can't afford to lose. And there you have it. Thank you for joining me on this quick investment journey. Please like and subscribe. And don't forget to comment below which theme you're most excited about. Until next time, happy investing.